on my desk. I actually have a teleprompter with my camera in it, so I can actually look at you, and like it seems like I'm looking at the screen, but I'm actually looking directly at you, which is cool.
This is absolutely cool. That's true. I hope
put a ton of time into my home office to make it great.
Yeah,
I got work to do back here, but this is good.
Thank you for the invitation to your home office. It's absolutely great. The first time that I heard about you was on the Investors podcast.
Oh, okay.
It was half a year ago, and it was the time when I was thinking about, is there any book on the market that is simple and easy for beginners to understand investing? Especially since in Europe, we have a huge problem with financial literacy. Almost nobody knows about investing, how to do it, what to do with money. And exactly
same problem in the US.
Really, it's the same problem?
Oh,
true?
100%. 100%.
I always thought the experts are in the United States when it comes to investing.
It's like anything. It's like, sure, there's, the small sliver of the population that understands this are the ones with the wealth and the knowledge, and they pass it on. But the financial illiteracy is a worldwide phenomenon, and the US is no different.
Oh, I didn't know that. I thought it's a European phenomenon.
Nope. It is global. We teach nothing about personal finance investing in school. Nothing. However, there are some US states that have actually mandated it as part of their curriculum. I think it's just a matter of time before it goes federal. That's my hope. So it'd be everywhere. So there are pockets, but don't think that everyone in America understands what the words that we're going to say. No, it's a tiny sliver of the population.
Yeah, it's the same here in Europe. So there are only a few schools that teach about finance and commerce and business, but the majority doesn't know anything. And
I graduated with a business degree, and I was not taught anything about the stock market, personal finance, compound, nothing. All this has been learned on my own.
But
I studied business.
Yeah. And what brought you to investing then?
Well, do you want to record this?
Yeah, we're on.
So. Oh, we are now? Okay, I'm sorry. What brought me to investing is after I graduated from college, my dad handed me a book called Rich Dad, Poor Dad. This was 2004. At the time, it was a very, very popular book. It was the first book I'd ever come across that had a couple of ideas in there that were really important. Everyone's in business for themselves. The rich think about money differently than everybody else do. The rich buy assets. The poor and middle class buy liabilities they believe are assets. Your house is not an asset. It's actually a liability. Save money and invest it. Now, I have qualms with many things about that book now, looking backwards, but it was a gateway drug for me to get really interested in money and finance and saving and everything related to investing. So that, I think my hunch is that interest has always existed in me. It's just that book unlocked it for me at the right time in my life. And it just kickstarted a love affair with learning about money and investing that continues to this day.
And I think then also this book brought you to Motley Fool. You're a writer at Motley Fool. I read on the internet. How is it? How is it there?
So I was a reader, a casual reader of the Motley Fool, starting in about 2004. I became a paid member of their newsletters in about 2008. In about 2012, they brought me on as kind of like they identified me as one of their star community members, and they gave me some access to things. And it was my dream for years to write for them. And in 2015, I became a full-time writer for them. I'm not an employee for them. I'm just a contractor for them. And that relationship continues to this day.
And did I read it right? You wrote 3,000 articles about investing for Motley Fool on the internet?
At least.
Wow.
It's 3,000 ones that are available to the public. I've written many more that are behind the paywall. But if you do it every day for a couple of years, they add up.
How much time did you invest? How many years did you invest in writing? In 3,000 articles, it must be 10 years, 20 years?
That took me about 5 or 6 years to get there.
Wow.
Yeah.
Wow.
I mean, that sounds like a ton. That's, about an article and a half every working day over that time period. So it is a lot. But that's the job.
I'm curious, how does your workday look like?
My workday has shifted substantially over the last 2 years. I've shifted away from writing much more towards audio and video, and that's how that's how I spend the vast majority of my my time now. I've also started some things of my own that have nothing to do with the Motley Fool. So my YouTube channel takes up a lot of my time. My newsletter takes up a lot of my time. My social media takes up a lot of my time. I still do work for the Motley Fool, specifically on their podcast and their live streaming, but it's much less writing nowadays, much more audio and video.
I saw your YouTube channel and I'm also a subscriber to your newsletter. It's amazing. I love it. I love the content.
Thank you so much.
And you wrote this book, which is absolutely great. The first question I have to you about this book is, what motivated you to put this book together?
So first, people need to understand something basic about me. I never would have guessed that I would be an author, ever. I am someone that has, I am a barely literate with the English language. English was my worst subject in school. I got mediocre grades in English my entire life. And I have terrible handwriting. I'm bad with grammar. I'm bad with spelling. Like nothing about my history says writer, like absolutely nothing. So I never had a dream to write a book or anything like that. When I started writing with The Fool 7 years ago, obviously I had to get better at writing simply because of the amount of effort that I had to put into the repetition. My early articles required ungodly amounts of edits because my writing skills were just so poor at the time. But for more than a decade now, I've had a nagging question in my head about investing books, and that is, I never understood why there wasn't a simple book out there that just explained in plain English what the stock market is, how it works, and how investors can take advantage of that. I myself love reading books about the market and investing. I've read so many wonderful books by Peter Lynch, about Warren Buffett, by Seth Klarman, right? All the classic books out there that people read when they want to read about the market, I've read and I've absolutely loved. However, I never found a book that explained the most important question that I had about investing. The most important question that I had was, why does the stock market go up? I think a lot of people have seen the chart of the S&P 500 over the last 150 years. When you look at that, it's as clear as day what you should do with your money, right? It's invest in the stock market. And the stock market has gone up about 10% per year, nominally compounded at that rate for over 100 years in the United States. That doesn't make sense to me intuitively. Why is there this thing that continually goes up in value? There's plenty of squiggles, plenty of back traces along the way, but I never understood what was the reason that this thing kept going up. Was it just a bubble? Was it like 100-year bubble that was waiting to burst? It was never explained to me, the relationship between stock prices and corporate profits. And I just firmly believe that 99% of people out there don't understand that relationship, the relationship between what stock prices are and what business profits are. The reason is the thing about the stock market that is crammed down our throat is price. It's price. You go in the news, what do you hear? What did the Dow or the S&P 500 do today? End of story. That's it. That's the only information you get. So if that is your relationship with the stock market, it seems like a random number generator. Some days it's up, some days it's down, right? Why would you pay attention to this thing that goes randomly up and down? What's missing from the conversation is the thing that drives price in both the short and the long term. And that thing is the businesses behind those indexes. So since no such book existed, my frustration after waiting for one to be written for years finally cultivated in me saying, maybe I'm supposed to be the one that writes it. And it took me about 18 months to do so, but that's why the book exists. I didn't think we needed another book about investing. I thought we needed one that explained in plain English what the stock market is for beginners.
Yeah, absolutely. You nailed it. Absolutely. It's absolutely perfect, because this is missing on the market. Basically, a simple explanation, let's say not oversimplified. You nailed every important point, but in understandable terms, which is really impressive. Other books that I read, I mean, behind me, for example, business books are very complicated. They are good written for the experts, but not for the beginner level. Your title is, Why Does the Stock Market Go Up? I agree to the title until the beginning of 2022, especially 2020, 2021 was mesmerizing on the stock market. In the tech sector in 2022, it doesn't look very good currently. So some corporates are corrected by 80%. Do you still believe that the title is right? Why does the stock market goes up over time? Do you think 2022 is an outlier and we will see better times in future?
I think the title is 100% correct. The title is not the stock market always goes up every year. The title is, why does the stock market go up? Why? Why does the stock market go up? What is the thing that causes the stock market to go up over long periods of time? And by the way, the publishing of the book would happen in April of this year, and it just shows you how bad of a market timer I am. Because if I titled it "Why Does the Stock Market Go Down," it probably would have done better, given what's happened. Absolutely nothing that I've seen in 2022 rocks my conviction in the things that I wrote about in the book. If you study market history, the data is unequivocal. The markets crashing is perfectly normal. Perfectly normal, right? We had a stock market crash in 2022 so far. 2020, although that was the shortest stock market crash in U.S. history. We had one in 2008. We had one in 2000. We had one in 1982. We had one in 1983 and 84. I'm pretty sure there was one in the 50s. We had the Great Depression, right? If you look back at stock market history, it's very clear. Every 10 years or so, things go to hell and the stock market goes straight down. And that is markets functioning normally. One of the reasons that stocks provide such high long-term returns is because every 10 years or so, they go down so much that they keep a whole bunch of scared investors away, people that don't understand how the stock market works. And humans are unfortunately born naturally to be terrible investors. We have so many innate biases that make us human that simultaneously make us very poor investors. One simple one is simply that we take our cues in life about what to do from other people. That is a very useful trait that kept us alive for tens of thousands of years. If you saw that your tribe was scared, it was in your best interest to act scared, to follow the herd. That kept you alive. If we do the same thing with our investments, we are doomed to fail. If you take your cues from other people, which, by the way, it's easier to do today than ever, given the proliferation of communications in our life. If you are looking at CNBC or Twitter, or you're looking at what other people are doing in market prices, and you are taking your cues from them, which is a very, very natural thing to do, what are you going to do? You're going to buy high and you're going to sell low. And that is the exact opposite thing that you need to do to invest well in the market. So once you understand that, it makes total sense why a whole slew of new investors got really excited about investing in October and November of 2020, which is when the market was at a peak, right? All these people were posting on social media about how much money they made by investing in fill in the blank meme stock or fill in the blank cryptocurrency. And they take their cues and say, I want that too. Conversely, what we've seen over the last 18 months is the exact opposite of that. Doesn't matter what you buy, you've lost money. And taking your cues from other people that are down huge and they're freaking out and they're selling, and you see all of the negative headlines, the natural thing to want to do is to say, forget it, I'm out. Investing is the worst. It's terrible. This is why my grandparents told me never to invest in the stock market. You're focusing on price and you're taking your cues from other people. If you do that, you're going to get bad results.
Absolutely. I remember from the last 2 years, GameStop, meme stock, Reddit, the Reddit investment community was quite funny. And also getting cues from YouTube until November. I think everybody was recommending Bitcoin and Ethereum and Solana and Avalanche. Now, almost a year later, I think most of the prices are still down by 60–70%. How was your crash experience in the last year since you mentioned some crashes, the dot-com bubble crash, for example? Did you invest already in 2000?
So I was not an investor in 2000. I was a casual observer of the stock market in 2000. I did have a couple of experiences with the stock market growing up, but I did not have money at the time. In the late 90s, when stocks were just going straight up in the United States, I was a caddy at a local golf course. And one of my fondest memories of the stock market was these golfers went into the turn, right? On the ninth hole, they went in to get some hot dogs and stuff, came out, I was a caddy, and they all had smiles on their faces, right? They were smiling because the Dow was up like 300 points that day. Didn't know what the Dow was, but these guys were clearly happy because they had made however much money they made, and they were high-fiving each other. And I was pumped. I was like, does this mean I got a good tip? Like, you know what I mean? Like, I was like excited about that. At the same time, I remember in September 11, 2001, when the markets reopened after that, I remember everything was just like straight down, right? And that was the response to the mania of the late 90s was the unwinding of that from 2000 to 2002. So like everybody, I saw that stocks went straight up in 1999 and went straight down in 2000, 2002. And my natural instinct was to say, this is the government's fault. Right. This is fill in the blank political leaders' fault, which is a natural thing to do. But now, obviously, that looking back, that's not how the market works. So I wasn't an investor then. I was an investor in 2008. I started buying stocks aggressively starting in 2004 and 2005. And I can tell you that period felt awful. Just awful. I vividly remember my wife and I had two incomes. We had no kids, so our savings rate was very, very high. We were plowing lots and lots of capital into the stock market. Every single time I did so, it felt like I was getting punched in the face and throwing my money into a furnace. Right? It was just like everything I bought immediately went down like by 10 or 20%. At the time, banks were going under, people were getting kicked out of their houses. There was unprecedented fiscal stimulus. Everything that could have been gone wrong seemed to have gone wrong in 2008. Now, looking back, so many of those purchases were wonderful decisions. So many of them. I got generational buying opportunities because I was investing in a period when the world was falling apart. But if I was taking my cues from everything that I saw around me, and I was watching what was happening in my portfolio, it seemed like foolish to invest at the time. It feels very similar today to how it did in 2008.
Yeah, I think this topic that you mentioned, cues, is very important. In the 90s, I was a student at the university. I studied business management, and the teachers always recommended buy stocks like Amazon, buy stock like Apple. But I said to myself, no, wait. So there must be something wrong on the stock market. Don't invest. So there was 96, 97, 98, and the stock market just went straight up. Felt like that. And I put my first money in the market in 1990 and 2000. And right after that, the market collapsed and crashed. So it took a lot of, let's say, nerves to keep investing, to cost average into the markets in 2000, 2001, 2002, 2003, and then 2004, 5, and 6, I think the market reverted. And it felt so great again. And in 2007, everybody was dreaming again of a new world order. The market, it can only go up, and the sky is the limit, or not even the sky. And 2008 was the next big crash. What is your take on crashes? Why is it necessary? Why does it happen that the stock market fluctuates so much, that it goes up and down like crazy?
So once you understand the business cycle and how the business cycle works, stock market crashes make sense. The economic cycle makes sense. Generally speaking, good times, economically speaking, lead to complacency, lead to investors being willing to fund crazy ideas, lead to new businesses being formed, lead to everybody getting rich, lead to all kinds of silly things happening with money in the market, simply because the times are good. When times are good like that, venture capital money is pouring in. New companies are raising money at insane valuations, and they're doing silly things with their capital. That's just how human psychology works, and we project out that the good times are going to continue indefinitely. Eventually, something happens globally that goes wrong, and that kicks off the start of the business cycle going in the opposite direction. We've seen this play out in basically real time in a super sped up environment over the last 3 years. The best analogy I can think of is almost like it's like a forest fire, right? Forests are healthiest after a forest fire comes through, right? All this brush that shouldn't be there just gets wiped away by the fire, and the biggest, tallest, strongest trees are the ones that last fine. But all like the dead wood gets cleared out, and that just creates this fertile environment for new plants to come in and to sprout from the carnage. The economy and the stock market kind of works the same way. After years and years of growth and overgrowth, it becomes ripe for something bad to happen. A fire comes through, and during that fire, bad businesses that had silly business practices or outdated practices or take on too much debt get wiped out. They close up shop, and when that happens, the strong businesses that prepared properly for bad times to come can go shopping on the cheap, or they can go on the offensive with their spending, and they can steal customers. They can take market share in a downturn. Now, there are tough periods for those companies too, but the strong companies survive and end up stronger because of the economic stress, and the weak companies end up weaker or die or get acquired during the periods of economic stress. At the same time, when the markets are heading down, people are getting laid off, and because of the economic stress, people are more willing to adopt new ideas and new technologies than they had been previously, right? Old business models, old technologies die, new ones emerge. An extreme example of this that we saw was in 2000. How many companies globally allowed remote work in February of 2020? 5%? 10%? I don't know. How many allowed remote work in April of 2020? 75%. All of a sudden, this fringe idea that was slowly taking over became we have to do this. We have to change our business practices because the world is demanding it. That is one small example of an innovation, a new business practice being forced upon the business community because of economic stress. That's why when things are going down, that's why the market eventually bottoms and recovers, because the bad is washed out of the economy, and that sets the stage for good to come in and for the economy to start growing again. It's an extremely painful period for everybody, but that is just a cycle that's going to repeat itself likely for the rest of our lives.
When I look in retrospect on the S&P 500, it seems quite logical what to do. For example, in 2000, take your money off the stock market at the highest level, then wait 2 years, reinvest it at the bottom, wait until 2008, take it off the market, reinvest it. I never was successful with that strategy. So usually I invest when everybody invests, and usually I take out the money when everybody takes it out. What is your interpretation? Why is it so hard for human being to resist temptation to run with the herd?
So let's talk about market timing first, because like you, I also can look back at any chart and be like, oh, it's easy. You buy, you sell at the top, you buy at the bottom. How is that hard? Why is market timing hard if it just clearly sell everything in 2007, invest it all back in 2009? The reason that market timing is hard is because we know the answers to the questions, and when you go back and look at the test with the answers in hand, it's easy to fill them in. What's incredibly hard is filling in that test with incomplete information in real time. Think about the last 3 years. The biggest news story this year is the war in Ukraine. The war in Ukraine. How many people were predicting that in January of this year? I bet it rounds to zero. Right? It was something that nobody was aware of, nobody was thinking of. But think of the massive impact that has had on the globe, on supply chains, on energy prices. The ripple effects around the globe are just enormous of that. Yet nobody was talking about that. Nobody could understand that in January of this year. It became clear a few months later that was going to be a big deal. But think about the impact that has had on market prices everywhere. How on earth would you know that? Even in January of this year, just a month before it happened. You don't know that. So you can't, even if you knew that, you couldn't predict how markets would react to that news coming around, because the global economy is so unbelievably complex that even if you knew that piece of information ahead of time, it would be really hard to predict what market prices are going to do. When you're making decisions, investment decisions today, you're doing so with all the information that you have available at the time. But the future is unpredictable. The future is just completely unknowable. There is going to be some event in the next week, month, quarter, whatever, that has a big impact on markets, and we can't predict that now. So that is one reason why timing the market is so incredibly hard. I vividly remember in 2017 saying to myself, I think the stock market's overheated. I think it had been up for 7 years in a row. We just had like a 30% gain in the stock market in 2017. And I said, this can't continue. The stock market is so unbelievably high. If I was a market timer, I would have sold everything in 2017. And I would have missed out on 100% gain, right? Because the stock market just went straight up from there. Interest rates remained low. 2020 hit, and while stocks declined, they just went skyrocketing. So my net worth would be lower today, substantially lower today, if I followed through on my gut. If you were to ask me what's going to happen forward from here, I would guess the stock market's going to go down. That is the gut feel that I have based on everything that I'm seeing. But I know my own history with calling market timing is incredibly poor. Rather than trying to guess and then second guess and then outguess yourself, I think it's a much better strategy, if you're in accumulation mode like I am, to just buy no matter what is in the news. Buy on a fixed schedule and accept that occasionally you're going to be really wrong and you're going to feel stupid. But over the long arc of time, if human ingenuity continues, those purchases will likely have a very positive outcome.
I think feeling stupid is a character trait that everybody must get used to when they start investing on the stock market. 2017-18 was also a very interesting year. I looked on the market and the global economy in 2015 and said, I mean, every big innovation needs one thing: it's semiconductors, it's chips. And every new invention, iPhones, smartphones, all appliances have a very large number of these items built in. So I invested a lot of capital into the chip industry. And in 2017-18, I thought that was absolutely crazy because everything went up except the semiconductor industry. They corrected sharply down. So I was looking to everybody was celebrating, and I sat there and said, oh my God, 70% down, 80% down. Why should I stay in that? But luckily I didn't sell. I mean, when I'm investing and when I'm in the game, it looks wild, it looks crazy. And in retrospect, you said that the S&P 500 always went up. What are the three forces, in your opinion, the three major forces that drive the stock market up long term? And just we don't end up in a crazy up and down game like in a casino.
Well, over the long term, there's really only one force that truly matters and drives the stock market in any given direction. That force is business profits, corporate profits. To understand why, let's ask the question, what is a stock? What is it? A stock represents fractional ownership of a corporation. When you buy a share of Apple, you become a fractional owner of Apple, the company. As a fractional owner, you have a legal claim on a portion of Apple's assets and profits indefinitely. That means that legal claim has economic value so long as Apple, the business, generates profits and is expected to do so into the future. Take any successful business today that is a giant in any way. Coca-Cola, Microsoft, 3M, Amazon, Apple, take any of them. Why did those stocks go up so substantially since they came public? There's one reason. Those businesses behind those stocks grew substantially since they came public. Growing means their revenue is substantially higher, their margins are stable, and their profits and cash flow are far, far higher today than they were 5, 10, 20, 50 years ago, whenever the businesses were created. That is the reason why any individual stock goes up over time. The business behind the stock becomes more profitable. Period. End of story. Now, there are lots of nuance to that statement, but by and large, that statement is correct. So why does the stock market go up over time? Take out the word individual company or business and substitute in stock market. A stock market is just a collection of individual businesses. The Dow Jones Industrial Average, the most famous stock market index in the world, is 30 companies. 30 companies that you've heard of, or you've heard of most of them. Microsoft is in there, Apple is in there, Salesforce.com is in there, I think 3M is in there, United Health Group is in there. Big, highly visible, profitable companies in the United States make up the Dow Jones Industrial Average. And those companies, by and large, are out there every day trying to grab more customers, get more revenue, and increase their profits. And as they succeed over long periods of time, their individual stocks will go up, and that will drive the entire market up over time. But this is something that is hidden from our view, because we don't see the profits of the businesses behind these companies. We just see the prices of these companies. But if you zoom out and view the stock market and the stock market earnings over any long period of time, that connection becomes much more visible.
Yeah, it's interesting. You mentioned Apple. I think the market capitalization of Apple is north of $2 trillion.
Mm-hmm.
I mean, in 1995, who could have imagined that companies exist with $2.5 trillion market capitalization? I'm not sure if it's still 2.5 with the latest correction, but Apple seems to be very stable on the market. When you look at other sectors, I mean, you mentioned we have a war in Ukraine now. That affects the European market. We have an energy crisis in Europe. I read that on the newspaper that the natural gas pipelines in the German Sea got sabotaged. So there is a lot of uncertainty on the market. Why should people care about investing in such uncertain times? What's your opinion on that?
Why should anybody care about the stock market at all? Why should we care about numbers on a screen that go up and down? The reason that I care about the stock market is I truly believe that the stock market is the greatest wealth creation machine of all time. If you pull up any sort of compound annual growth calculator and just calculate what would happen to your net worth, your wealth, if you just put small amounts of money into the stock market, the U.S. stock market, over long periods of time. And by long periods of time, I mean decades. I mean decades. If you were able to invest just a few $100s a month into the U.S. stock market starting in 2000 or 1990 or 1980 or 1970, any long career, you can literally turn a few $100s a month into millions, into millions. And it's never been easier for individual investors to do that. We are blessed today with tools, with information, with zero cost trading, with index funds. And these tools make it so that you can have, with very, very little cost, you can continuously invest your money into the stock market, which historically has gone up somewhere around 10% per year, annualized nominally. Nominally, meaning that's how much the absolute value went up. If you subtract out inflation from that, the real wealth creation of the stock market is about 6.5%, something like that, in that ballpark over long periods of time. That rate of return outperforms bonds, it outperforms cash, it outperforms gold. Real estate's up there, but it is a wonderful asset class for investors to get to put money into and to grow their wealth and net worth over time. That's the reason I think people should care about it. The stock market is a easy to use tool for building wealth in the long term. Doesn't mean you have to care about it. If you're not interested in growing your net worth, and if you're not interested in growing your wealth, or if you're not interested in the stock market, there are other avenues available to you for investing and for growing your wealth. I just think that the stock market is one of the easiest ones for investors to understand and put their money in.
Yeah, that's true. That's true. The first time I got interested in the stock market was in the 80s. And I was 12, 13 years old. And it was next to impossible, as in I grew up on the countryside. Opening an account to invest in stock for a 12-year-old boy was next to impossible. When you look at the technology today, with Coinbase, for example, everybody can invest in cryptocurrencies. There are also fractional investments in stock possible with Austrian products, Bitpanda, for example. The technology is much better and the availability of investment opportunities is much better. How was it when you started investing? What were your most pressing questions as a newbie investor?
When I first started investing was 2004. At the time, I think the broker that I was using was the cheapest broker on the market. It cost me $7 to buy, $7 to sell, which was like most other brokers, and their fees had come down substantially. We're still in like the $20 or $30 range to transact. So the fact that we have tools now that you can invest for $0 and your expense ratio can be like a few hundredths of a basis a percent at a year, it's extraordinary. That has been a tremendous gift that investors have been given by lots of companies, but a huge amount of that gratitude is owed to Jack Bogle, the founder of Vanguard and the creator of the index funds. But when I first started investing, I wasn't taught anything about what the stock market is or how it works or how to get started. I was taught nothing about that. And I say that as someone that studied business in college. Studied business in college, and I was still largely unaware of any of the common terms that I've since looked up on my own. My biggest question by far was, why does the stock market go up? Why does this thing seem like this random number generator go up over long periods of time? Why should I care about it? How do I invest? Like I know people that literally their first question to me is, okay, I'm interested in investing. Do I go to a bank? Like how do I actually put money into the market? Like lots of people just don't know about the simple fact that you need to open a brokerage account to invest. That's the kind of information that is missing out there from society. Forget about what the PE ratio of fill in the blank index is or anything complex. I think people have lots of questions about the extreme basics of the market. The good news is, all of it's easy. There's nothing hard that you need to really, you don't need to know any advanced math to do well in the markets over time. You just need to firm fundamentals of the basics. But many of the questions that I answered in my book is essentially 60 plus chapters, and each chapter is a question. All right, a question like, what is the Dow Jones Industrial Average? Those were the most common questions that I had when I first started investing, as well as the questions that my followers and friends helped me to come up with. So every important question that I had informed the creation of the book.
No, the book is absolutely a go-to place for getting answers, getting great answers. I loved it from the first to the last page, and I also marked the chapters. When I look, I mean, Robinhood, for example, I don't know if this app is still alive for the company with the latest crash, but this was something that I wish I had 30, 40 years ago, so that I can start investing right away as a child. The first investment attempt that I had on the market was basically buying index funds, European ones, not the American ones. Also, ETFs didn't exist in that form in Europe, were not accessible. What's your opinion on Warren Buffett's favorite advice to newbie investors? He says that the S&P 500 ETF, Vanguard, for example, is the best product for everybody. It secures you participation in the US economy with an almost guaranteed average 10% return rate. What's your opinion on that strategy?
I mean, who am I to argue with Buffett? When people, my default answer for if I'm interested in the market, how should I invest is index funds, right? If you want to go with the Vanguard 500 index fund, great starting point. If you want to go with the total stock market index, another great starting point. The reason I recommend that to people, to I would say 99% of people, is because in my experience, 99% of people have no interest in the stock market. They're just not interested in it. If the idea of reading an SEC filing or listening to a conference call or figuring out what a market capitalization is or reading financial statements, those things bore them to tears. And that is perfectly okay and also perfectly understandable. If you have no interest in following individual companies and learning how to invest and put your money in index funds, call it a day. You do that plus dollar cost averaging is the key thing that most people need to know about how to invest in the stock market and how to maximize their chances of doing well over long periods of time. However, if you are in that 1% of people, that weird 1% of people that's interested in the market, that is fascinated by the market, that enjoys investing, that likes to dig into details, that likes to learn business models and mental models, and likes to judge management teams, which, by the way, I am a member of. If you're in that 1%, then I think it's okay to buy individual stocks. There's a lot of work that you have to do if you want to invest in individual stocks the right way, which is why I say to so many people, don't do it unless you're interested. But if you're interested in learning, it's never been easier to learn about how to invest, how to dig through companies, how to sift through business models and through SEC filings. And if you enjoy that kind of thing, invest in individual stocks.
What can you, I would like to hear in your words, what is cost averaging? Dollar cost averaging. You mentioned it a couple of minutes ago.
Yeah, so there's a couple of definitions of dollar cost averaging. Dollar cost averaging is the idea that you take a fixed amount of money and you invest that fixed amount of money into an asset on a preset schedule. For example, let's say you commit to investing $500 every month into the S&P 500 index fund. That is something you can set up once. And then on, let's just say, the first of every month, $500 leaves your broker account and it buys the S&P 500 index fund in some preset amount. The wonderful thing about that decision is you make that decision once, and then you're on an automated schedule for buying regardless of what's happening with the market. If the stock market's up, you're buying. If the stock market's flat, you're buying. If the stock market's down, you're buying. Doing so removes all of the emotions and all of the questions that you have about when should I invest. So dollar cost averaging can be a wonderful, wonderful strategy for people to follow, and also tends to match up very nicely with how the income that most people have. A lot of people around the world get a salary and they get paid every week or every 2 weeks or every month. And if you can just commit to taking a portion of that and investing it continuously, I think that's a great strategy to go after.
Absolutely. There are many videos on YouTube these days who explain the effects of compounding. What's your explanation of compounding?
Compounding, I think Ben Franklin said it best. And he said, compounding is when the money that you make makes money. And that process continues indefinitely. Compound interest, Einstein quoted, it's attributed to Einstein. It might be misquoted, but it's the eighth wonder of the world. He who understands it earns it. He who doesn't understand it pays it, right? So it's the idea that capital is invested at some rate, and that the investment return you get on that capital is reinvested at that same rate. So your money grows at a faster and faster rate over time. Let's just say you earn a 10% return on your capital. You put a few $100s into the market over a period of 20 years. And within 20 years, let's say you have $500,000. That's amazing. That's a fine result, right? The amazing thing about capital is, what's a 10% return on $500,000? $50,000. $50,000. That is more than you would invest in a period of 5 years of putting a few $100s into the market. You make that just from having your money compound for one extra year. And this happens again and again and again. This is how the wealthy become wealthier. over time. They build up a sizable nest egg for themselves, and that nest egg compounds at such an extreme rate that even though they're living very lavish lifestyles, it's small in compared to the net worth that they're creating for themselves just through compound interest. So it's an incredibly powerful force that you need to understand, and thankfully you can put that force on your side.
Yeah, and 50,000 for most people here in Europe, it's more than the annual salary, the annual average salary that the majority has. And they can unlock it with small monthly payments when they start early, so in their 20s, and invest constantly. I mean, this cost averaging and S&P 500 ETFs or any other ETF is a great idea. And at some point in time, I decided I invest directly in companies. I can do it better. Yeah, Warren Buffett. I now understand why Warren Buffett is such a great investor with 20% return annually over a few decades. And in another TIP episode with Brian Lawrence, I heard something that is really unbelievable. Brian Lawrence mentioned a story that he, I think 20 years ago, asked Warren Buffett, how can he become such a great investor like him, but faster? And Warren Buffett mentioned in his story that every stock on the stock market in average goes up and down by 80% every year, which I couldn't believe. So it was basically the reversal of what Warren Buffett generally recommends, investing in S&P 500. And in Brian Lawrence stories, the recommendation was more buy at the low price and then sell at the high price. What do you think about this? The average stock goes up by 80% every year. Is this valid in your opinion? Is this really such a high fluctuation on the market?
Oh yeah, I think what they're referring to is the difference between the 52-week high and the 52-week low for a company. So it's not that every company goes up 80% every year. It's the variability between the 52-week high and the 52-week low is about 80% per year. I've also heard that, and that's an average. In relatively calm years, I think the difference is much more muted at 40 or 50%, and in relatively volatile years, like we've seen, the difference can be 150% or more. So yes, stocks do have huge variability to them. And of course, if you could buy at the 52-week low and sell at the 52-week high, yes, you would do much better. But that is the definition of trying to time the market. And I personally don't believe there's anybody that has the capability of doing that. Because keep in mind, the 52-week high and the 52-week low might happen. 52-week low first, 52-week high comes after, and it might also be the reverse, as we've seen in 2020, where the 52-week high was earlier in the year, and now it's the 52-week low. So how would you buy low and sell high in this year, for example? But yes, stocks have plenty of variability to them. And to me, if you buy at the 52-week low and it goes up, that is more a factor of luck than anything else. Short-term returns are random. Short-term returns that you get on your money reflect changes in the mood of the market and the mood around that stock more so than the change in the fundamentals around those stock. And I know of no way to predict the changes in the mood of other investors in a company. So I don't even try to do that. One thing that's often overlooked about Buffett and his sensational performance is a couple of things. First off, markets in 1950 in the United States were really inefficient. Very inefficient. You could find high quality companies that were trading at 3 times earnings, 4 times earnings back then, simply because information was so hard to come by, right? Buffett researched companies one at a time. He got a big book of them and he started reading top to bottom. He could find opportunities in part because he just did a tremendous amount of manual labor, far more than other investors were willing to do so at the time. And you couple that with the fact that companies were trading at 3 times earnings, 4 times earnings, 5 times earnings. In that kind of environment, I think earning a very high return, knowing what we know now, would be far easier than it is today. Today, there are supercomputers that are calculating those kind of decisions in fractions of a second. So the information edge that Buffett had previously is far harder to come by today, especially with the big liquid stocks that are out there. However, one big advantage that Buffett had then that he does today is Buffett had permanent capital. permanent capital. Buffett invested the money that his insurance companies made to float on that. So not only did he not have a management fee that he had to pay, but he didn't have investors clamoring for him to give his money back at the worst possible time and giving him tons of money at the best possible time. So he had time. He had truly could take a long-term mindset and approach buying businesses with a long-term view. That's not something that a lot of big mutual fund managers can do today, or hedge fund managers can do today. That is something that individual investors can do. So while the information edge that Buffett had is largely gone, and the cheap valuations is also largely gone, investors that can take a long-term view still have an edge.
Yeah, it's he has still something. I mean, I love tech stocks. I'm working usually with life science companies and with venture capitalists. So I have a favor for tech stocks, high tech stocks and deep tech stock. And in 2020 and 21, the ARK funds were celebrated. I think Cathie Wood had in 2020, 150% return on her fund. And there was a discussion on the internet in chat rooms that maybe Warren Buffett's approach is outdated. When I look now at his returns in 2022 and compare it with ARK Fund, he's still averaging his 20% per year, which is quite interesting and quite amazing that he continues to deliver these returns. Many investors, many new investors, when I talk to them, worry about making mistakes on the stock market. So like myself, buying tech stock at a very high point, like in November, and then losing 70-80% right after. What was your biggest investment mistake that you can talk about?
So first, let me talk about Cathie Wood for a second, because I think that's very interesting. So Cathie Wood had really skyrocketed to popularity in 2019, 2020 in particular, when people were just plowing money into her funds, and her fund was up, an ungodly amount in 2020. Over the last year, we've seen the exact reverse of that, when her fund and her style has just gone completely out of favor, and we've seen an absolute collapse in prices. However, if you pull up the long-term chart of Cathie Wood's ARK Innovation ETF, her flagship fund, and chart that against the S&P 500, would it surprise you that she's outperforming since the fund was created? Would that be? I'm curious how many people actually know that. Now she's outperforming the S&P 500 by an incredibly small margin, 0.6% right now. So all of the outperformance that she had prior to this has essentially been given back, given the enormous drop in tech stocks. But Cathie Wood and the rise of her and the huge popularity that she experienced in 2020, and then the downfall that she's experienced more recently, is just an unfortunate thing of being a visible fund manager. She can't control when people plow money into her fund, and she can't control when people pull money out of her fund. But I like to judge managers by their long-term track record, and Cathie Wood's ARK Innovation Fund is actually ever so slightly outperforming. That is not easy to do. That doesn't mean that I think that Cathie Wood is going to outperform moving forward, or I agree with everything that she does, but people tend to judge fund managers over the wrong time period. All we've seen over the last year is her style went dramatically in favor to dramatically out of favor. That's it. And that is the returns that she's gotten. Actually, now that you say that, I'm really curious if she has outperformed Berkshire Hathaway since her fund was created. And let's see, the answer is yes. Her fund, since it was launched, the ARK Innovation ETF, which was launched, I think, in late 2014, is outperforming Berkshire Hathaway by 20% over the last 7 years. Does that surprise you? I mean, I have a feeling that a whole bunch of people aren't even aware of that fact, just because the only thing they're focused on is the extreme negative returns more recently. But time will tell whether Cathie's strategy actually pays off in the long term or not. But the volatility that her investors experience has been very, very high. Obviously, I forget what your initial question was. Sorry, I went on a little.
No, we can say it there. I mean, I like her investment style because it looks to me like she is resembling venture capital investment style on the public market, so less private market, and the volatility in tech stocks is just insane. I mean, many companies, I think also that she invests in, are pre-revenues. Still, they are public listed, but not pre-revenue in a term that they're not profitable in a way, which is, I think, on the public market creates much more volatility than in the private market. So this is my take on Cathie Wood.
Yeah,
Why do you see these
that's a
wild
feature
movements?
of being a public company. You are subject to the whims of the public markets. Of her ARK innovation in ETF, I heard top holding is Tesla. After that's Roku, then Teladoc, then Square, then Zoom, then Shopify, then Spotify, then Twilio, Coinbase, and Unity. I believe that all of those companies are revenue generating. Not all of them are profitable by a long shot. And I personally disagree with several of her opinions on companies, but that's her strategy. But we like many of the same businesses. And her number one holding, Tesla, she's been right on for since she's been out there beating the drum out at. So only time will tell if her strategy holds up over long periods of time. But the downside to being a hyper growth investor is, while it's lots of fun on the way up, it sucks way harder on the way down. And by the way, my style is also very high growth. Tends to be favor high growth stocks. So 2020 was a very fun year. The last year has been no fun.
Yeah, that's true. That's true. The last years were hard. The initial question was, what was your biggest investment mistake?
Okay, thank you. Sorry for that roundabout communication. I've made so many mistakes in investing. And while it's easy to look back and say, well, my biggest mistake was not just plowing it all into Amazon on day one and calling it a day, or actually Monster Beverage on day one. That's obviously not a mistake that I would have ever gone for. All my mistakes really come down to me wanting market beating returns as fast as possible. Right? Me thinking that I could outsmart the market, outtime the market, and not really understanding the nature of how businesses work. Now, I've bought plenty of stocks that have permanently lost me 70% of my capital. Right? I bought them, I was wrong, they went down, and I lost money on that. I've done that with leverage too. My number one holding at one point, I put options on, a bullish option position called a synthetic long. That position then fell 70%. So not only did my number one position lose 70%, I did it with leverage. Leverage. That was a painful lesson to learn about a leverage. So I bought lots of terrible stocks. The worst investing mistakes that I've ever made, though, on an individual stock level, is buying a great company and then selling that same great company way too early, simply because I was in a rush to take a profit. I sold Microsoft at $24. Microsoft is currently $235. So I missed out on a 10-bagger in Microsoft simply because I was in a rush to take a profit. I bought it like 20. I sold it at 24. And that single decision has cost me more money, more lost wealth than a whole bunch of the terrible stocks that I bought and then rode down and then sold for huge losses. I've done that with another company called Dexcom. Given the split adjusted price, I don't even know what my split adjusted price is. It's got to be around $1. No, it's got to be less than $1. And Dexcom is currently $81. So I missed out on an 80+ bagger simply because I was in a rush to take a profit. And I've done this on many companies. So the biggest wealth destroying decisions I've ever made is buying something, being in a rush to sell it, and then that stock goes on to deliver tremendous returns for investors.
Yeah, holding on is sometimes quite challenging. You mentioned some stock. I mean, Tesla, for example, I think until 2019, it doesn't look like the stock will ever move upwards. It's just my memory. But correct me if I'm wrong. I think the entire time from 2010 until 2019, it looked more like sideways. And there were some articles on the market that Tesla will go bankrupt and they will not be able to raise money. And then suddenly the stock went up, just up and away. And I think also the ARK funds went up. There are so many different styles on the market. It's quite interesting. There is Cathie Wood style, investing in growth stock. Then the interesting thing that I saw in Warren Buffett's portfolio is that I think from his public companies, almost 50% of his investment is in Apple. 44, 46, something around that.
Huge bet.
And then there is Dalio, who recommends with his all-weather strategy to just diversify into the market. What is your strategy currently when you think about investing? Is it more the Dalio style, investing in the entire market? Is it more the Warren Buffett style, go big on one holding, or as you mentioned before, a little bit Cathie Woods with her growth approach? What is most attractive to you?
My style is, first off, I'm an individual investor. I don't have fund. I don't have anybody else to report to. I'm not managing anybody else's money, and I refuse to, quite frankly. I have no interest in managing anybody else's money except for my own. Because of that, my style, my investing style, is largely a diversified group of high growth companies that I think have the chance of being multi-baggers over the years ahead. Now, that is a volatile strategy that I deploy. While so I own dozens of stocks, many of which I'm sure are going to be worthless one day or decline substantially. But if I occasionally buy the next Tesla, which I did in 2012, and I hold it, that's the only thing that's going to matter. That's the only thing that's going to matter, is if I occasionally get the next Tesla, the next Amazon into my portfolio. However, that is a volatile strategy. It's a volatile strategy. The way that I mitigate that volatility is by keeping my personal finances extremely conservative. Extremely conservative. My personal finances have multiple sources of income, have a high savings rate, have a 6-month emergency fund, and have zero debt. Zero. Okay. That is extremely conservative personal finances. And that extreme conservatism in my personal finances allows me to absorb a large amount of volatility in my portfolio, because I know that if my portfolio is volatile, like it's been over the last 3 years, actually even longer than that, that volatility in no way impacts my day-to-day life. None. There's my family's living situation is not impacted at all by any volatility that could come my way. So while it's mentally painful for me to see my portfolio get smashed on occasion, like it has over the last year plus, it doesn't impact my personal life, my actual living, my actual day-to-day life at all, because again, my personal finances are so incredibly conservative. So that's the model that I've chosen to do. Ray Dalio, I think, is brilliant, and he advocates for the all-weather portfolio, and he's been out there making macro calls that have seemed to really come right. I know that his portfolio is doing very, very well. Buffett likes to take concentrated bets in a small number of companies that he owns and knows very well, and that style works great for him. Other investors take more diversified approach. There's no right or wrong way to do it. The best way to invest is the one that best suits your personality. I know a great investor that would be perfectly happy having 80% of his net worth in one company. As long as that company earned its spot there and had an incredibly bright future ahead, he would be comfortable with that. I wouldn't be able to sleep. I just wouldn't be able to sleep at night. Anything beyond 15% of my portfolio makes me uneasy. So I would be personally selling that company, even if I believed in it, simply for risk management purposes. But that's the way that I chose to approach it. And there's lots of ways that work. You just have to find the one that works for you.
And learn from mistakes. I had once a larger bet in the portfolio. Unfortunately, the company doesn't exist anymore. It's smart words that you mentioned. Build multiple income streams, no debt, and diversification. I think this is definitely something that everybody can take away. We are at the end of our conversation. Did I miss anything in the podcast? I have one question left. Did I miss anything that you would like me to ask you?
Nope, we covered a lot.
Then I have one question left. If you could go back to your younger self when you started investing, and you could give your younger self one investment advice from your experience that you have right now, what investment advice would that be?
That's hard to say. There's a lot of things that I could say there, but by and large, I'm very happy with the way things have turned out. For me, I'm very happy with all the painful lessons that I learned along the way, because they've made me a better investor. But if I had to do one, it would probably be think long-term.
Brian, thank you very much for your time and this great conversation. I can recommend your book to everybody who's interested in investing. And I wish you and your family a great time, successful investing, and hope to talk to you soon.
Thank you so much for having me. It was a wonderful conversation.
Thank you very much. Have a great day. Bye.
You too.